apologize. Maybe I should start wearing a watch. So it's there was a question there. Yes, please. So I will repeat the question, which is a good question. It's a two-part question. So really looking at the principles of the trend is your friend until it's not, and invoking stops and stop losses, and how do you sort of capture that trend or avoid the false trends, and do you invoke options in your risk management systems? So maybe Denny, we'll start with you.
Well, we don't use options per se in our strategy, but we employ a proprietary oscillator filter in our strategy, which will, for instance, in May of 2010, when there was a flash crash and the equities dropped very fast and subsequently bounced back, a lot of CTAs got hurt during that month just by the fact that they got short and then they got stopped out. With our filter, allowed us to stay out of that noise, and we actually ended up on that month. So I think CTAs will often employ certain filters to filter out the noise in the marketplace. So that's how we do it in our strategy.
Jay, do you want to maybe comment a little bit on the risk management systems and so forth with regards to this question?
Yeah, first of all, we're not Bernie Madoff. We're going to lose sometimes, and that's good. The second thing is that in terms of the trend, the idea is to somehow come up with this magic way of determining what an objective will be or where the trend should end so that you get out. That's kind of impossible. Interest rates are zero now. When I started, the short end was 21%. It's zero now. Who would have ever thought we'd go from 21 to zero? Who would have ever thought that the stock market would reach 14,000 after being about 800 in 1981? So I guess the point is it's hard to get at that, and so you have to stick with it. Now, while you're sticking with it, what you're trying to do is determine actually how much dollar risk you're taking. And so what ends up happening is you actually do a sort of a delta hedge. I don't use options. I don't like paying premium. I like to create an option, a long option-like strategy using futures. I feel that's more efficient and that's cheaper in the long run, both for the investor and for our ability to process. So as markets move and you're taking more dollar risk because, say, you've bought a bean at 10 cents and it's now 20, or oil at $30, it's now 100. Well, then you're going to have to account for how much risk you're taking. So therefore, by definition, as the trend accelerates, and if it moves in one way or another, you're changing your size so that you have the constant risk, i.e. the constant expected risk in your portfolio. The second thing that you do is you look at how what your overall portfolio mix is. You're not trading one market in a vacuum. You're trading markets with many other markets, which create sort of this construction of a portfolio, this mix of markets that also changes your risk profile, because you might then have a trend very strong, say, in grains, which can be offset by putting more emphasis in your bond portfolio because they're so very uncorrelated, and therefore as one comes off, another one might start. I mean, those are the kinds of things that you can do, but I'm not a big believer in setting objectives, because I find that you can, as long as you're managing your risk, you don't know where markets will go, and that's the beauty of it. You're trying to extrapolate those outsized gains. We were sitting around yesterday talking about how well things did, how we did last year. People made money in equities. We made money in cotton. I mean, how many of the guys at this table think, have cotton as more than 2% of their portfolio? But we made a lot of money in cotton. Why? Cotton went crazy. It went to numbers no one would have suspected. You have to let that happen while you mix it in your portfolio, while you manage the dollars at risk. Otherwise, there won't be anything left.
Those are some excellent points. Some more questions, please. I mean, we have a tremendous opportunity here with regards to the panelist.
And it came up a bit yesterday regarding, on the panel, regarding margin to equity and ways to understand CTA risk. If you're seriously looking at CTAs, you need to understand this concept of how to define the risk around a CTA exposure. And the tool we use in our industry is margin to equity. Gross notional leverage type concepts don't work. So you need to look at margin to equity. And when you look at managers and you look at their returns, and it's the combination of what kind of return, what kind of vol, what kind of drawdown, how are they correlated to other things. A key part of that is how much money they take or how much money they put at risk to make money. And when I was at TD Bank, that was called your RAROC, your risk-adjusted return on capital. And it's an extremely important thing to understand if you're going to judge a CTA. If you have a CTA who generates 12% annualized with a 12 vol and has worst drawdowns at 12 and does it with a 15% margin to equity, that is not the same as the same CTA who does it with a 6% margin to equity. They represent two totally different risks. So it's something I encourage you to look into.
Now, one common theme that is resonating from these discussions is really with regards to the tremendous amount of importance that's put on the risk management, the risk controls, the risk philosophy. And this is something where, for the systematic managers, the risk management is built on the front end. And so it is really a situation too, as Tim just articulated, that there are different kinds of, there's a lot more flexibility and a lot more possibilities with regards to calibrating the risk at a level that is congruent to what an investor may be looking for or seeking. And so these kinds of, this kind of flexibility is pretty unique with regards to the managed futures, and in particular the systematic managed futures industry. Okay, yes.
Actually, I was going to follow up on something that you said earlier. You're talking about having roughly $300 billion under management and the potential of raising another $300 billion with CTA participation wrapped up in 40 Act companies. My question is, can the industry actually assimilate another $300 billion and put it to work properly and not have it become a drain on your total return?
Excellent question, and because you were kind enough to use the mic, I don't need to repeat it. Well, let's start with Eve, please.
First answer, I started in the industry, we had 26 billion. I started in 93, and as a relative size with respect to the traditional asset, we were much smaller than we are today. And we were worried if we ever hit 60 billion, we'd be in trouble, and then it was 100 billion. As a relative size with respect to total asset, we're still quite small. Maybe if the mutual fund, not the mutual, the total long-only space does not increase past 10 trillion and we go from 3% to 6%, that may start to be a little bit of a problem. But there's also a huge diversity in the space. And I know from my observation from 93 to today, our return per 5-year period, if I take away the interest that's part of our return, and you find out that we actually make more money in the last 5 years than we were making in the 90s, where we are significantly larger. And we were worried about, and clearly this is a concern one has to have. And so far it doesn't appear to be happening.
I don't think it's a risk at all, Eve. I mean, if you look at the size of the underlying markets, that's key. I mean, the futures market is a way. The futures market on equities is just another way to access equities, but the underlying market is the equity markets. Same with fixed income and same with currencies. case of commodities is a little bit different because commodities are not a capital formation market, it's a hedging market. But even there, if you look at the growth of global GDP and what percentage of that is consumed by the production of primary commodities, and that most of the emerging growth story globally is still infrastructure and commodity driven, the increase in participation on the commodity side has been as great from the hedging side as it has been from the speculative side of the business. So I actually don't think that doubling the industry is going to at all diminish the ability of CTAs to make money. One of the big reasons why, or two of the big reasons why, one is that the underlying asset markets are huge, and the other is that cycles of human behavior don't change. You've talked about the decision-making process of long-only investors. I hinted at how we make decisions and tend to extrapolate the present into the future, and that's what creates these sort of cyclical imbalances. Those things aren't going to change. The other thing, and Eve, I think you pointed about it when you said your rates of return adjusted for interest rates have improved. As an industry, CTAs have evolved themselves. They've become much smarter. They're using much greater research horsepower than they used to. In the early days, it was naive trend following, very simplistic strategies. Today, we run asset allocation models, dynamic risk overlays. We're measuring downside volatility value at risk, tail risks in the portfolio. We're using advanced math to try to come up with other sources of return that we can exploit. So I don't think you're going to see a diminished rate of return. Rather, I think you're going to see the industry improve as it gains market share.
One thing to add to that is the growth in the CTA space in the last couple of years from 200 billion to 300 billion, that 100 billion primarily went to about 6 managers globally. The biggest in the space got the bulk of that assets. And so what I would suggest is it's the same thing every time, is find the right managers, because some of those managers running 10, 20 plus $billion CTA portfolios, they do have a capacity issue. And so I think it really just boils down to the same thing in any part of this business that's been talked about for 2 days. It's manager selection and those type of concepts.
One thing I wanted to point out is, part of the bad news about doing something for 30 years means that your hair gets grayer every day. The good news is, though, is that you've had to evolve to stay. And we've actually built a model which we implemented this year. And part of the reason that it works is it takes advantage of the behavior of trend following. We actually make markets for trend following in the way that we trade. And I think that that's sort of the nature of, the group of people that use futures. You can skin futures any way you want. There's so many ways to buy and sell and combine, the liquidity, the transparency. And so as things change, the nature of the trading is going to change, because the very inefficiencies that you speak of and have already occurred create trading opportunities that smart people look for, see, and then try to exploit. And then what that does is it creates more liquidity for the original investor.